The Federal Reserve is meeting again tomorrow to decide on what direction the federal funds rate is headed. So we're going to have just a quick common sense conversation about, what they're likely to do and what that means for your money and your investments for at least the next handful of months. They have 2 more meetings after the one coming tomorrow. They're going to be meeting in November and they're going to meet again in December to finish out 2023. So most analysts and projections do not believe the Federal Reserve is going to raise rates again in this meeting, in the September meeting. They believe that it's more likely they're going to raise towards the end of the year in November or December. What is most important to understand is that the Federal Reserve will not be cutting rates or pivoting for the foreseeable future. The data that they're depending on to help make their decision continues to indicate that inflation is sticky and in some areas still hot. With that having been the case, this is how you need to start perceiving the next foreseeable 6 months or so when it comes to your money and your overall personal finances. The first thing you need to be focusing on is protecting your income at all costs. Whatever verifiable income that you have needs to be top goal priority to protect it and expand it. Make sure your banking relationships are firm. When you're going out to get any type of funding, it's ideal if you have a checking account set up that's showing some kind of recurring deposits or at minimum, a solid base of deposits that you sit in that account to give these institutions more comfort in lending you money. When it comes to any investing perspective that you might have, if you're in position to be investing or considering investing, if you're sitting in cash, CDs and high yield savings accounts will remain attractive for the foreseeable future. If the Federal Reserve either raises rates or stays flat, high yield savings and CDs are going to be very attractive right now. So lock in on those 3 to 9 month CDs because that's where the best rates are right now. Or if you want a little liquidity, focus on high yield savings accounts. As far as the stock market is concerned, that deserves its own analysis as a whole because it's so diverse. But I will say that if you're looking to get in on some of these tech stocks, Teslas of the world, in different stocks and companies that have taken a hit since the Federal Reserve has raised rates, you want to buy on a dip on these different stocks. You want to consider them now and for the foreseeable 3, 4, 5 months to come. The Federal Reserve will not be cutting before 2023 is over. That is almost completely out of the question. So if you're looking for an opportunity to buy in, this is your time to get in on some quality stocks that are compressed due to higher interest rates. Any of you who watch this channel, and if you're new to this channel catching this content, I'm a massive advocate, at least for now, on the residential real estate market. If the Federal Reserve stays flat or raises rates, that means mortgage rates will stay where they are or continue to climb possibly. That means the downward pressure on the housing market will continue forward. And that means those who can swim upstream and get in on residential real estate now, whether as a primary residence or as a owner of rental properties in quality residential areas, you're going to likely see great potential for appreciation at least the next 2 to 3 years. So get in if you can. Lastly, I would say those of you who are skeptical that the Federal Reserve, whether victorious or in defeat, starts to cut rates, which is likely to come. We're closer to that no matter what direction. We're closer to the Federal Reserve pivoting than we were yesterday. Those of you who are skeptical about the overall economy overall, and you do not believe that things are headed in a healthy direction, that, no matter what the statistics say, ultimately that the underlying economy and the US dollar, etc., is not headed in a healthy place, then you need to be focusing on stacking precious metals and learning more about the resource sector. Stocks in that area, that's where a very large proponent of wealth is going to shift if you're correct and the overall economy or inflation or the US dollar, whatever the geopolitical events, whatever it is that you are concerned about, takes hold and drags our economy down or, drags the dollar down in an unhealthy way, whatever the case may be. Those of you who are more skeptical of the broader picture, you need to be focused on precious metals, gold and silver, and any other, resource aspect of the resource sector. So investing in stocks, that's where a lot of the wealth is going to go. And I can tell you right now, as somebody who studies that space pretty well, that the case for precious metals and resources right now is very strong, even if the economy is okay or inflation is taken care of by the Federal Reserve and they're victorious. I can tell you right now, the case for owning precious metals and the case for investing in precious metals companies and resource companies is pretty strong right now. I just want to give you guys a quick overall view, get away from all the jargon, the stats and the charts and statistics, and just talk about on the ground facts about where you need to be when it comes to the overall economy in connection to your personal finances as the Federal Reserve pushes us further down this road. To all my pioneers, welcome back. To my new viewers, welcome in. If you want to learn more about myself and the channel, start in the description section and work your way to the about section of the channel. Most importantly, like the video, subscribe, comment down below, and let me know what your thoughts on this analysis is, what direction you're headed in with your personal finances. Other than that, I want y'all to stay focused, stay in motion. I'll see y'all soon.